Well, good Monday morning. This is Rich Morrison, and welcome to my latest edition of the Thinking Cap. Today, I'm going to talk about the charts a little bit, give you an update on what's going on. We're moving into, well, we've already moved into a very important time. Weather markets are certainly at the forefront right now. We're looking today as we start the new week at a reasonably decent weather forecast. We've got some heat building across much of the country, but we also apparently have some decent precipitation opportunities over the next couple of weeks. You can make some arguments on out into July that the forecast is starting to get a little hotter and drier, but the market doesn't seem to be caring about that right now. So I'm going to step back here a minute and look at the charts and kind of show you where things are at here as we begin the week. And you can see on the screen, we've got a lot of red. Markets all a little bit lower this morning. Corn, beans, wheat, cotton, cattle, even the hog market is kind of slipping back a little bit. So let's go through the pages. December corn. We'll start here. Let me move this out of the way. December corn has broken back below its 9-day moving average line. Last week, there was a lot of talk about a head and shoulders formation. And a head and shoulders formation, if you look at the head, that was this spike that we had back in May. We traded up close to $5 a bushel. We had a shoulder previously at 481, and there was talk that maybe this market would bounce back up and make that second shoulder at 481 or give or take. It didn't quite get back to that level. And then on Friday, the markets reversed lower, ended up trading lower again here this morning. And you can see technically not a good look. The RSI has turned lower. Stochastics lines have turned and even threatening to cross back lower again. So this market, might go back and make a test of that June low, 458 and a quarter. We're about 7 cents above it here at the moment. A lot of lines on this screen, so I can kind of give you a quick update on what we're looking at. All these moving average lines, the red, the blue, the gold, the 9, the 20, 50, 100, 200-day moving average, those tend to be levels that maybe accelerate buying or selling. If we trade above the 9-day moving average, you see a little buying come back in. If we trade below it, you seem to see some selling pop back in the market, and they seem to provide resistance or support depending on which way the market's going. So those are important lines. The crop insurance lines, I always refer back to these because I like to market above the crop insurance price. Well, guess what? This morning, we're back to a half cent below the insurance base price that was back in February. So, really from a revenue standpoint, you're not able to improve your revenue guarantee today. You're basically selling grain. If you sold it today, you'd be basically locking in what you've already got with your policy, except for you've got your deductible with the policy as well. Margin protection insurance. We continue to go back to that policy this year because to me, it's providing a put option essentially at 95% of 509, which is about 480 a bushel. So if your county were to have an average yield, and I know that's a lot big if at this point, but if your county comes in right at average, then the way margin protection is set up right now, a price below 480 would start to trigger a payment. It's about where that shoulder was. And so today, margin protection would be in the money, I guess you could say, depending again of what the final county yield ends up being this year. So I look at the corn chart today, a little bit negative. Things have turned lower, and it looks to me like we're maybe threatening to go back and test that recent low. Switching over to soybeans, the November beans, I've mentioned this a couple of times recently on last week's Aftermath, but I think the bean market is probably as bearish of any crop market there is right now. And that even takes into cotton into play. But beans have a fundamentally bearish story right now. We are finishing up harvesting what's going to be a record South American production between Argentina and Brazil. We're talking bigger bean acres here in the U.S. this year. So far, so good as far as the crop goes. We're over 70% good to excellent to getting started. So there's really no big issue at the moment here for this bean market. And you can see we've traded beans down to the lowest level since back in late February. Looks to me like that February low at 1122 and 3/4 possibly come into play. But the RSI at 32, stochastics at 6 and 10, probably nudging into oversold territory. So maybe you look at that February low as holding here at least for the moment, until we see what weather is going to turn into late summer. We're trading 20 plus cents below the insurance price today. So I don't want to be a seller right now with an oversold market. If you bought margin protection insurance, that thing looks really good right now at that $12.95 at 95%. We're probably more than $1 in the money right now. And so you'd be looking at a significant potential payment if the county yield were to come in unchanged. Flipping over to the wheat market, wheat has had a brutal run over the last couple 3 weeks, and including this morning where we broke below the 100-day moving average line. That was our last moving average support. And now that we're kind of into no man's land, where do you go from here? Probably should draw a little bit of a trend line, maybe connecting these lows, but that's still below 575. So probably tells us we've still got some more downside potential in this market. The only positive would be kind of like soybeans. The RSI and stochastics way oversold right now. So maybe you search out a low here over the next couple of days. The insurance prices, if you're in the southern states, we're setting the harvest prices right now. Northern states will start in July. But you can see we're well below the insurance price once again. I can look at Kansas City, Minneapolis. They're very similar looking charts. The cotton market made a new low here this morning. And cotton, every time it tries to rally, it stops at the 9-day moving average here lately. And that's continuing to trend lower. And it's continuing to keep a lid on this market. The Chinese economic numbers continue to be bearish and continue to really, provide a headwind for this cotton market. And we just haven't had any problems yet to talk about weather-wise. We're seeing, it looks like weather in West Texas as good as it's been in a few years at this time of the year. So we haven't got a bull story to trade yet. Now, the only positive I would say here, if you're participating in the Stacks program, Stacks essentially at 90% of 83 cents. That's about a 10% deductible, 8.3 cents, call it 9 cents, whatever you want. So anything below about 74 cents, then Stacks is providing basically like margin protection. It's providing like a put option. And so if your county yield were to come in unchanged this year and the price stays below 74 cents, you've got some protection from that Stacks policy. So a big reason I don't want to have to be a seller right now, I would, stand way back on the sideline at the moment as far as trying to have to sell cotton. Count on that Stacks policy to protect you as prices tend to drift lower if they do. Now, again, you look at the stochastics and the RSI probably indicate this market's probably closer to a bottom than a top. Let's look at the livestock market real quick. I find this feeder cattle chart pretty amazing right now because we've continued to narrow this pennant formation. We're trading up to the upper end of it right now, but we've yet to be able to break out of this pennant formation that's been really controlling this market for several months now. Unlike the grains, the indicators kind of nudging higher a little bit at the moment. So RSI and stochastics kind of pushing up, and we've nudged up against the top end of this. If you're a hedger, might not be a bad opportunity to take advantage of right up here against, this 262, 263 area. You've got stochastics and RSI pushing up into the upper part of the range. So not a bad place to be looking at maybe doing some hedging and maybe look at the LRP insurance policy. For live cattle, the live cattle market has broken out of the top. We've broken this downtrend line on Friday. We gapped higher. You can see these little gold lines. It's pretty small, but we did gap higher on Friday. Today, the market a little bit softer, but we're still holding above that downtrend. So, again, not a bad place to be defending this price, considering the rally we've had to the upper end of the recent range. And then finally, let's look at the hog market, because hogs have been, we've beaten the heck out of this hog market for several weeks now. And finally, it looks like on Friday, the hog market had a reversal trade. We traded to a new low at one point, yet finished the day higher. Broke through the 9-day moving average line this morning. We've turned the RSI stochastics higher. I'm going to take hogs out of the not zone today for the first time in over a month. And so this hog market seems to be, probably starting to generate some upside to it. And so where do you logically look at some resistance? Well, the 20-day moving average at 94 cents, the 200-day at 97, probably the 100 and the 50-day moving average lines up around $99 would be the next sales target that I would probably have in mind. So if we're able to ride this momentum up, maybe we get the opportunity to get some hogs hedged. So don't want to do it today. The cattle market's probably the one I look at today as if I want to lock something in, and I would consider doing that with the LRP coverage. So that's it for today. I appreciate the opportunity to visit with you. We'll look to get back together soon, and thanks for listening to this week's Thinking Cap video.